some of the topics that will be taken thereafter. Yes, we all know that in this country, prior before the problem we're now having in oil as a means of raising revenue, the government never took taxation serious. But presently, you can see everyone can feel it. You can feel it in the different forms of taxes being imposed, both consumption tax, income tax, and the rest. So government is taking tax seriously. Now the question is, what is tax or what is taxation? And the definition is that tax is a compulsory contribution, charge, or levy imposed by a government to a state on individual, firms, or property in order to fund government or to realize a government's socio-economic and or political goals. So the point is that tax ordinarily is not something you pay willingly. You don't pay it out of volition. The government doesn't need your consent to pay it. It is compulsory and you have to pay it. So it could come in the form of charge or levy, even though jurisprudentially some people have actually argued that levy is not a tax or whatever, trying to define what is levy and what is charge. Like for instance, if you're going to the airport and you're passing through, you have to pay before you get access. Are you paying it for the service you get and all that? But the most important thing is that this is a compulsory contribution you could make from your income as an individual or as a firm or impose on a property, and that the government does not need your consent to impose such. However, the most important thing is that, legally speaking, that every tax law must be backed up by legislation validly made by the appropriate tax authority, appropriate tax legislature before such could be said to be a valid taxation. So in summary, taxation involves the transfer of resources from the private sector to the public sector, moving money from individuals, from companies, from properties to the government purse. So this implies that a government does not need the consent of individuals, as I said earlier, before it enforces its tax laws. So there are judicial authorities, which you'll get later. After this, my slides will be shared, and I have written articles that were published in some international journals that which, if you care to go further, you read. But that's mainly on the division of taxing powers and the power of local governments to tax. So taxation is one of the, what you say, is one sign or a government used to show, demonstrate its sovereignty over its people that the government governs. So when a government, we have a territorial space like in Nigeria, the Nigerian government, either federal government, could impose tax on the people. It's a sign of demonstrating that this is a sovereign nation, and therefore we can tax our people the way we want without interference from outside players. This has always been the traditional view, but I think presently this may not be wholly true, considering the interconnectedness of the world we live today. The world we live today demands that there is cooperation between countries, and now you have competition. When there's tax competition about amongst countries, you could see other countries trying to adjust or make the environment so conducive for people to bring in money and invest. And of course, you could ask yourself, what about the tax havens? Countries that don't tax or help people to hide income. You've heard about the Panama Papers, which mentioned several prominent people in the world. So most countries that are involved in this, they benefit from that. However, the OECD, Organization for Economic Cooperation and Development, which is an organization comprising mainly developed world, even though developing countries like Nigeria, some are being members, not as observers or whatever, not as full members. The OECD is doing an important work in trying to regulate tax policies of its member countries and other countries in the world, mainly to fight tax evasion and profit shifting and the rest. So a lot of policies are being fashioned out. Presently, issues of companies exploiting other less developed countries is a serious issue that the OECD has actually come up with a lot of policies and trying to ensure that there's an open policy where the activities of companies, especially the multinationals, are visible so that there is cooperation. And in that sense, one could say that the issue of sovereignty, exercise of sovereignty in tax administration appear to have been whittled down a little bit. So now, taxation is also one sign to show that there's a social contract. Some of you who probably have a background in social sciences, political science, or sociology must have known about the social contract theory and different social contract theories, such as James Rhodes, Thomas Hobbes, and the rest. The most important thing is that there is a contract that appears to be between the people and the state. I'll pay my tax. You force me to pay tax, but there are things you need to do for me. For instance, the provision of social amenities, good roads, water, security. Everybody is crying today in Nigeria that there is lack of security in the country. The government is collecting taxes. The government is collecting taxes from individuals and from companies, and yet we're having problem of security of lives and property. People don't like to travel by road anymore because of issues of bad roads and security issues. Now, all these things try to play a role in issue of tax compliance. Why do people pay tax and why do people fail to pay tax? I've also written in that area in relation to issue of compliance. And one of it is that if government must have the moral authority to collect tax, government must do what it's supposed to do. The social contract between the government and the people must be seen to have been performed. Not just that you do that. You have to provide security, you have to provide good roads, water, and electricity. Those public goods that individuals cannot provide for themselves, that's the essence of government. And you use tax to do that. This takes us to what I have already discussed, the primary reason for taxation. Want to raise revenue for government expenditure. You people fund government through taxation. You provide, so the government can provide social amenities. Things that even if you're a billionaire, you can't provide yourself, all those things. If you're a billionaire, you can't provide yourself clean air or road, safe road from here to different parts of Nigeria. You need government to do that. And for government to do it, you have to pay your tax. To maintain law and order and redistribution of income amongst different income earners. Redistribution of income, I've said this severally, especially among my students, that one part that it appears the country is failing is in the redistribution of income. There appears to be serious concentration of income on one particular group of people. And when you say this, then you know that the tax law is not effectively enforced and implemented. As a student in Canada, I remember that every quarter, the Canadian government will send us paychecks, send us checks. Especially, that is those who file income tax. They don't file income tax that mainly because they will pay tax. It's just for government to know what your income threshold is. Have you been, are you earning below the normal income threshold expected of someone in a society, you know, in order to live a good life? So when you file your income tax, the government will look at it. In fact, the statistic shows that a greater percentage of Canadians who file income tax don't only file income tax for the purpose of paying tax, but just to let government know that they are below certain, the particular level expected of someone in a society to live a good life. With that, you can qualify for public housing scheme. You'll be placed in a public housing scheme. You will be you'll be receiving paychecks from the government. So these are the things that government does with taxation, and also use it to control crime, because a lot of people go into crime because they probably feel that they don't have any chance to survive or opportunity in the society. Then to serve as fiscal device for actualization of social, economic, and political goals of government. You can see, I'm happy with what is happening. Since 2019, the government has been coming up with the Finance Act that was not what it was before. But since 2019, you saw the Finance Act 2019 made several amendments, both in the corporate tax, the issue of online taxation, that brought in the significant economic presence test and the rest, so that, well, companies that have significant economic presence in Nigeria, even though they don't have fiscal presence or fixed base in Nigeria, could be liable and could pay for the money they've made in Nigeria. So even in the 2020 Finance Act also has made that same amendment affecting Personal Income Tax Act, which was not done in the 2019 income tax. The point is that the tax laws, especially annual, are used to change the direction of government fiscal policy yearly. Now, on the types of taxation, I'm going to be very brief here. We're looking at different types of taxation. Progressive tax, you have it, and you have proportional and regressive tax. So the question is, what is progressive taxation? When do you say that a tax is progressive? A tax is progressive when higher taxes are imposed on those who earn more. That is, the more income you earn, the more taxes you pay. So this is dependent on the ability of the taxpayer to pay the income tax. In Nigeria, theoretically, we could say that yes, in this country, that is what we are practicing, especially as it relates to personal income tax. For those who probably is the first time you are coming into tax, please know that there are different regimes within the tax law. You have personal income tax. I'm sure somebody is going to take you on that. Corporate income tax or company income tax, which is governed by CITA, Company Income Tax Act. The personal income tax is governed by Personal Income Tax Act. Petroleum Profit Tax Act, Value Added Tax, Education Tax, and the rest. You're going to see that. But this progressive tax we're looking at now in Nigeria applies more when personal income tax is involved. And the personal income tax, when you look at the sixth schedule of the PITA, the sixth schedule of the PITA contains the graduated form of personal income taxation. It is graduated in the sense that it provides that, the step-by-step how you bunch out the taxes, depending on what you earn. For the first 300,000 naira, 7% applies. The next 300,000 naira, 11%. Next 500,000 naira, 15%. Next 500,000 naira, 19%. And the next 1.6 million, 21%. And the last rate is 24%. So the tax rate is actually relates to the percentage that the tax authorities now impose on your income. So as I have just explained, when you go to the sixth schedule of the Personal Income Tax Act, you will see that it is in a graduated form. So in principle, it is progressive, but whether or not this is applied and enforced is a different thing altogether, because a study has shown that the Nigerian economy is dominated by informal economy. An informal economy is an economy that is, you could say, this is a black economy, this is an underground economy, whereby a lot of people are not within the tax net. So many people are not within the tax net. So the people that actually pay tax in this country are mainly civil servants, salary earners, and especially those who actually gotten into within the tax net. And that's why the tax authorities, FIRS, and some states are coming up with tax identification number. But there are so many people, lawyers, medical doctors, who are practicing on their own, actually operating in informal economy. So how do you tax them? So a lot of people are earning income without paying tax. There have been postulations that have been made on how to get them, how to get those people pay tax. Because one, to determine what they've earned is a problem when there's no documentation and the rest. Then the next one is proportional tax. Proportional tax refers to the tax system which uses a flat rate. You use a single flat rate for everybody. As we have seen in the personal income tax in Nigeria, there's nothing like that. But you will see that in corporate income tax. When you look at the company income tax, before the 2019 Finance Act amendment of Section 40 of CETA. Section 40 used to impose 30% for every 30% for whatever any company earns. But with the introduction of the Finance Act in 2019, companies have been divided into three groups. One is the small company. A small company is a company that earns a gross turnover of 25 million naira or less. So when you earn 25 million naira or less, the company is considered to be a small company. And the rate is actually zero. So perhaps the government made this amendment in order to help small companies grow. But that does not mean you will not file your income tax. You still have to file your income tax to show, the company has to file its income tax to show that its gross turnover in that year is actually 25 million naira or less than that. Then the next one, if you look at Section 22 of the Finance Act 2019, it defines this. What a small company is: medium-sized company. A medium-sized company is a company that earns a gross turnover greater than 25 million naira, but less than 100 million naira in a year. So a company that is in this group is required by the law to pay its income tax at the rate of 20% of the total profit of the company for that year. Then the next one is the large company. A large company is a company that is neither small nor medium sized. So which means that such a company earns a gross turnover of 100 million naira or more. And the rate, of course, is 30%. So if you look at Section 16 of the Finance Act, which amended Section 40 of the Company Income Tax Act, you will see where the rate appears. And for the definition of what each of the companies is, you see that in Section 22. So we could say that this is proportional, because they are flat. As long as you fall within this group, that's what you pay. Some people have argued that a proportional taxation, if applied to personal income tax, could be deemed to be regressive. And the regressive tax is, regressive tax regime applied means that the more income you earn, the less tax you pay. So I don't know of any country in the world that claims to apply this sort of income tax. Now we move. I have 1 hour to finish my lecture, so we move to tax. We move to the canons of taxation, tax policy and canons of taxation. Now, earlier it is pointed out that taxation involves the transfer of wealth from the private sector to the public sector, and this suggests a reduced economic power in the private sector. It suggests a brief reduced economic power in private. So, and this is the price that every one of us pays for public goods and services that benefit the society. Therefore, tax policy is concerned with the efficiency at which the transfer, the transfer of the wealth from private sector to the public sector, how it occurs. So, in other words, we're looking at what are those qualities that is expected of a good tax regime. Adam Smith had actually done a good job on this in his book, one of his classic, Wealth of the Nation, where he listed out 4 canons that every good tax regime must embody, and that is equity, certainty, convenience, and efficiency. Some other tax authorities, writers would treat equity and fairness together. So what do you mean by equity? What it means is that people who are similarly situated should pay similar tax. And that is what we call horizontal equity. Horizontal, in the sense that, well, it appears that that is what actually the graduated form of tax under the 6th schedule appeared to achieve, by placing people who earn similar amount of money to pay the same income, the same kind of income. So it doesn't make sense that the income tax or any tax system is heavily tilted towards punishing a particular group, maybe the poor in particular, because, well, the rich could afford to pay as more tax as they could. So now that equity is horizontal when people who are similarly situated pay the same amount of money. But this raises a lot of philosophical questions and issues about why should someone who earn more should pay more. Somebody will say, well, you use up your time out of 24 hours a day, you work almost 20 hours a day and sleep only for 4 hours. And someone may decide not to even not to work and sleep all around. And why should I pay more? So why not give us a flat rate so that everybody will pay flat rate no matter what you earn? And okay, you spend money going to school and you have student loan to pay. Unfortunately, people in Nigerian undergrads here perhaps may not know what student loan is, even though Nigeria has a student loan board before a country like Canada. But I don't know how many of us that have gotten student loan from our government. So if you've gotten student loan to go to school, to be a lawyer, to become a lawyer, you have money to pay back to the government. And now you have to pay more tax than someone who didn't go to school, who didn't have to work and depends on from the taxes you pay, social amenities and public goods and services are provided for them. So these are issues. However, it is agreed that when taxes should be equitably imposed on people, regardless of how the circumstances they find themselves, because without the society, the education you have, you wouldn't have had it. The business you have and the money you are making, you wouldn't have had that. That is horizontal equity. And vertical equity is, to spread the income. There should be spread. In the United States today, one of the problems, one of the political, in fact, tax should be one of the political issues. And because in Nigeria, they say we'll suffer from resource costs. Resource costs because the country depends more on petroleum. We don't care, after all, nobody is using my money to pay this. Even though some people, especially in the South, the environment are being destroyed and all that. The resource cost is such that a research has been conducted that in most developing countries that have enormous resources, they do not do well economically because people don't ask questions. You ask questions, the more governments start to tax you. You start to ask questions. How do you use more? How do you use our money? So there should be distribution of income. In US, for instance, the Republicans will say you should tax the rich less. The Democrats will say tax them, tax the rich, get the money, spread it to the poor. So that is it. That is how it is in most other countries. You collect money from the rich and then spread the money so as to carry everybody along in the distribution of income. So certainty, a good tax regime should be able to show certainty. Like, I should know how much money I'm going to pay in tax. People should know what the tax law is without unnecessary changes. One of the disadvantages somebody may say, well, even though we try to use the Finance Act that the government had decided to come up with every year to make a lot of changes to change virtually all the Nigerian tax regime, some people may say, well, this does not show that someone, especially if you're from outside and you want to invest in Nigeria, this show of certainty for you to know exactly what you are going to face tax-wise. Because in the next year, the government could change the law through Finance Act, and it's a different ballgame. So convenience, tax should be easily paid. It should be, I should treat convenience and efficient. Convenience, it should be easily paid. The government should make it structure its tax administration in a way that should be very convenient for people to pay tax. And people shouldn't see tax as a form of punishment and you are fighting with your government. For instance, the Australian Tax Authority, or what you call the taxpayer charter. Even in US, the IRS and other state tax authorities appear to be friendly when they call you, friendly to encourage you to pay your tax. There have been a lot of theories on the issue of what makes people to pay tax. For instance, the economic theory will say that if someone knows that when you cheat, when you evade tax, you'll be caught and you will be punished for it, that humans generally are rational. They will try to avoid such punishment by complying. But when they know that they can easily evade tax and nothing happens, they'll continue to do that. So, but government should be a carrot and stick approach, and to make the environment convenient and conducive for people to pay tax. And it should also be efficiently administered. You can almost use 30 minutes. Division of taxing powers. That's where we are heading to. In Nigeria, in theory, there have been a lot of issues surrounding the Nigerian constitution. A lot of people have said that the Nigerian constitution is not an act of the people, it's not autochthonous. It was militarily imposed, but whatever it is, that is the law we use today. So when you look at the constitution, you find out that the constitution, for the constitution, of course, is the ground norm and very fundamental to anything you want to discuss about. You cannot talk about taxing powers without referring to the constitution. So now, what does the constitution say about taxing powers? Taxing powers are connected with legislative powers. Because in a democracy, you have to have, in a democracy like ours, you must have the laws validly made by the appropriate legislature imposing tax or tax collection. So in this, Dr. G. Elias, actually, one of his unpublished papers, which I was privileged to read, he mentioned that taxing powers operate at two levels. One is the power to impose tax, and another one is the power to collect tax. So what are these? The power to impose tax means the power to charge, the power to levy taxes, and also to change the rate at which tax is exigible. So if you can't change the rate at which tax is exigible, then it means you don't have the power to impose tax or to charge or to levy. However, you also have the second taxing power, which he mentioned was the power to collect tax. He cited an Australian authority, which is Ray Diamond. It actually said that the practice in Australia has been that for every tax law that is made, there's always two legislation. One is to impose the tax, and another one will decide who collects what. So the power to impose is different from the power to collect. When you look at the Nigerian constitution, you find out that, yes, our federal system of government, the constitution appears to recognize three levels of government, but in essence, in the partition of taxing, in partition of legislative powers, you only have the two. Exclusive legislative list, which you all know, the National Assembly is the only authority that's allowed to legislate on that, and the concurrent legislative list for the state government. So, of course, federalism implies that ordinarily, even though that in Nigeria here, we continue to partition, divide existing states. If you go to US, the 50 states in America, most of them, some of them were either sovereign authorities on their own or quasi-sovereign that came together and decided to form a country. The same thing in Canada. The provinces, different provinces, they could tell you this was the time the province joined the union. This was the time this state in America joined the union. So now the powers, the exclusive legislative list in our own constitution anyway, belongs to the National Assembly. And when you look at almost all the taxing powers mentioned in the constitution appear to be in the exclusive legislative list. When you look at item number 58 is on stamp duty, and item 59 is on income, taxation of capital and incomes, and the rest. So when you go to the concurrent list is supposed to be a list that contains the powers of both the National Assembly and the state houses of assembly to legislate on. Even though Professor Ben Wabeze has actually argued that how concurrent is the concurrent legislative list. Because if you come to the concurrent list and decide to partition powers, that's a problem. But in relation as it relates to tax, if you look at item 7, it is item 7 of the concurrent list, item 8 of the concurrent list, 9 and 10 that are relevant. In item 7, the Constitution says that the National Assembly could delegate power of collecting all those taxes mentioned in either item 58 of the exclusive legislative list or item 59 of the exclusive legislative list to the houses of assembly. save with the exception of power to impose, power to collect company income tax. So this may take us to the provisions of the Taxes and Levies Approved List for Collection Act, which divided taxing powers between the federal government, state, and local governments. You can look at the act, but fortunately, unfortunately, that act was actually declared to be unconstitutional by the Court of Appeal in the, I think, your local government and Akwa State. The reason given by the court was that because of the introductory part of that Taxes and Levies Approved List for Collection, which says that notwithstanding the provisions of the Constitution 1979, I quarrel. I do not agree with the decision of the Court of Appeal in that case, because the Court of Appeal failed to take legislative history of that act itself, even though some people have actually quarreled with that, because that act was promulgated during the military regime. And the military regime, it was during the military regime. Of course, you know that the military regime, there's nothing like the central government, either the Federal Supreme Military Council or whatever, is the highest, both legislative and executive powers were lumped together. And any edict that conflict with a decree will be null and void to the extent of its inconsistency. And any unsuspended part of the Constitution will be null and void to the extent of its consistency. Because the first thing the military does is always to suspend the Constitution. That was what they did. The Court of Appeal in your local government and Akwa Ibom refused to take the judicial history of that, the legislative history of that act. If it had done that, it would have known that the provisions of Section 315, that is the existing law clause, had overridden that very particular clause we're talking about. Because say that any existing law, and except if the Court of Appeal was able to show that it is completely incompatible with the provisions of the Constitution, which is not the case. We do not, maybe when we have time, we'll look at that. We'll look at that maybe at the question time. So the point now is that the federal government appear to have the powers listed in the exclusive list. The powers, the taxing power the local government, the state have in actually item 7 relates to the same taxing powers mentioned in item 58 and 59 of the exclusive legislative list. So there's no particular tax mentioned outside this. However, residual power means, which is driven from section 47 of the Constitution, is that a state also relying on the powers, the federal power, under the principles of federalism, that those powers not mentioned or not given to the federal government and not mentioned anywhere in the Constitution belongs to the state. So there's an article I'm going to give you, which I wrote, I co-authored the article with Nduka, my very good friend, on the powers of the, whether or not Value Added Tax Act has fettered the power of states to make, enact sales tax laws. I used the example of Lagos and Enugu state government in arguing the taxing powers in that regard. So where some people try to say that the moment a federal government enacts a law and the state goes in there, it covers the field. The doctrine of covering the field relates to the powers mentioned in the concurrent legislative list. If the federal government goes outside the power that is in the exclusive list or concurrent legislative list, then that will be null and void. That will be unconstitutional. And the Supreme Court has actually held that position in the case of AG Lagos and AG Federation. I think that decision was decided by the Supreme Court in 2014. So, so now, as it relates to federal government and state government, there is no doubt that both federal and state exercise certain levels of taxing powers. Under item 7 of the concurrent legislative list, the power that is there is only the power to collect tax. The power to collect personal income tax. The Personal Income Tax Act, if you look at its legislative history, it was a military decree enacted during the military regime, and which survived the Constitution by virtue of section 215, the existing law clause of the Constitution. Now, that is where the state government now derives the power to collect certain personal income tax. And if you look at section 2 of the PITA itself, it says that individuals should pay tax to the state where they reside. Section 2.2. Then non-Nigerians, anyway, non-Nigerian residents, the taxes they pay from the sources, from income they derive in Nigeria, is payable to the FIRS, regardless of wherever the person lives. So the point is that the power to collect, as it relates to item 7, is what the state government can, can exercise as far as item 7 of the concurrent legislative list is concerned. Now, it is funny somehow when you hear some states will say, "Oh, we will make sure that this kind of group of people don't pay tax. We will stop so and so, or we'll change the rate." No state government has the right to change the rate at which personal income tax is exigible. You don't have the right, because the power to change that law belongs to the National Assembly, except those laws that the state has the power to impose, has the power to legislate on, that they can change. And none of them, as far as the taxing power, if you read Professor Nwabeze's constitution, he appeared to say that, well, the powers to tax, the state powers to tax is not different from what you have in the exclusive legislative list, which subject to where the National Assembly allows you to do that. However, the state has the power to impose taxes outside those items in the concurrent legislative list or exclusive legislative list, and it is within their own exclusive, even though the Constitution did not mention the word exclusive or the word residual, but we do know that residual powers belongs exclusively to state government. Now, for local government, it appears that generally, if you look at the US Constitution, look at the Canadian Constitution, the Swiss Constitution, you will see that there is always a binary arrangement in all federal constitutions. Binary, you won't see the word local government in US Constitution, but that does not mean you don't have local administration or district powers. But these powers are lumped together. The state government or provincial government handle this. So, but in Nigeria, our constitution recognizes local government. But if you look at section 2, subsection 2 of the constitution, you'll find out that that very section recognizes only the state and federal government. However, in section 3, sub 6, it recognizes local government, but there is no special power granted the local government. And this led to some authorities. My very good friend, Professor Researcher, has actually argued that local government does not have any taxing power. I will advise you to read his paper as well. If you want, I can send it to you. But I also published a paper which counters that. In that paper, my argument was that taxing powers, as we have seen, actually operates at 2 levels, the power to impose and the power to collect tax. Yes, the section 7, subsection 1 grants the state government the power to ensure the existence of a democratic local government in every state. Now, section 7, sub 5 also, if you look at section 7, maybe we can, we can read section 7, subsection 5 of the Constitution. That section reads, let me get it, let me pull it up. Section 7.5 reads that the functions to be conferred by law upon local government council shall include those set out in the first schedule to the Constitution. So what does this mean? So which means somebody will ordinarily say that this power is actually the power that is only a state government, only the power delegated to state government delegated to local government by state government, that the local government can actually exercise any taxing power. And without such delegation, the local government does not have any taxing power. But the problem is that when you read the wordings of that section, let me go back again. It says that the functions to be conferred by law upon local government shall include, the operative word shall is what I'm looking at. Now, the question now is whether the federal or state government has the discretion to grant the powers which are listed in the first schedule. Is it a discretion or it is a command that the law has issued? And we all know the interpretation of shall means compulsory, you have to do this. So if the Constitution has indirectly conferred the power to collect those taxes and the state is directed to make those laws, will you now say that local government does not have taxing powers? I think I'm going to, in summary, my argument was that the local government has the power to collect taxes. And in in the case of Knight Franks and the kind of state government, the Supreme Court has actually held that a state government cannot usurp the local government power of tax collection. So that is that. But in practice, if you find out that some state they go and write an agreement with local government, which are most of the local government chairmen are either appointed, non-elected, appointed by the state governors, or you know the kind of election we conduct in this country, and they're all subservient and controlled by state governors, to the extent that even federal allocations could as well be accounted to state governors. So there are a lot of problems. In my article, I actually looked at all these issues. So yes, the case Knight Frank and Rotley, Nigerian Limited, and the kind of state government. Before my time is up, I will look at some of the basic concepts of taxation of income. In Nigeria, we will have specific tax legislation for personal income tax and for corporate income tax and others. In other countries, for instance, in United States and Canada, they appear to have one legislation for all this, most of the taxes, if it is a federal tax. But I need to touch at some of the points you are going to meet at the time you are looking at the technical issues in either corporate income tax or company income tax, corporate income tax or personal income tax. One of them is valuation. Valuation. What is valuation? How do you determine the value of a particular thing in order to ascribe an amount to it for the purpose of taxation? It is a serious issue in tax. So if, for instance, I have my salary, you pay me 100 naira, and I know that it's 100 naira is my salary, there's no valuation problem there because the tax law knows that 100 naira is what this guy has earned. And as we will see that if you are a salaried person, you don't have much opportunity for issues of deduction expenses, some of the outgoings and expenses, which traders and business people enjoy. You definitely will not have that. So those who are going to take you on personal income tax will look at those provisions, section 20, on deductible expenses and outgoings and the rest. So, but in this valuation now, as I'm talking about, I'm referring at, so how valuation could become a problem? It becomes a problem when, for instance, let's say assuming I bought a land somewhere in Lagos or in Enugu, and this land, I bought it at the price or the cost of 5 million naira. After 3 months, people tell you, oh, the price has now gone up to 5.5 million. So 500,000 naira is what you have on top. So will you, at that point, say that one has actually earned 500,000 naira? Okay, let me give a different example. You are a worker in a company, and there are certain perks. If you look at the Constitution, if you look at either the Personal Income Tax Act or Company Income Tax Act, perquisites, allowances, different forms of allowances are being taxed these days. So what you now have is what you call consolidated relief allowance, which you could see under section 33 of the Personal Income Tax Act, which is 200,000 naira or 1% of the gross income, whichever is higher, plus 20%. That's what the law gives you. So the issue of, okay, this one is a meal allowance, I went for a particular travel and all that, may not be available to you. But assuming it is available to you, and of course, the tax law considers any particular allowance or pay is given to you as part of your income, other than that consolidated relief allowance, which will be given to you. Now, you are a worker. You may be the type that likes to travel. You've been dreaming to go to, you want to travel to Seychelles or Dubai or one vacation, one place like that. And your company decides to hold a conference, in that area. And the value of the travel, the money you will spend in hotel and everything is about 5 million naira. Now, if you embark on that travel, of course, you love traveling. You've enjoyed yourself. Will the law now say that this is part of your earnings? Because to add it up, ordinarily, yes, it will. That's what our law says. But what about somebody who doesn't like to travel? That person hates flying, hates traveling, and when he travels, what happens? The law is that it is expected that the law should be able to balance that. Our tax regime, especially as it concerns the decisions of the court, are not that developed like the laws in other developed countries like United States or Canada, where some of these things will constitute serious valuation problem. And the question would be, the court could look at both ends. So it is difficult to determine whether this person, so it's not just an objective assessment, but subjective assessment. But how do you understand that this guy likes to travel so that some of those perks should form part of his income? Also, and of course, net income. The next one is net income. Net income deals with, you understand that, how do you determine how much I'm going to pay? Am I going to pay tax on my gross, which includes expenses incurred in generating that profit? The law allows you to take away outgoings and the expenses, which are, if you look at the provisions of the law, I think section 20 in Personal Income Tax Act, either 24 in CITA, it says that the expenses that are wholly, exclusively, reasonably, and necessarily incurred towards generating that profit, they are deductible. They listed some items. For instance, interest payable on money borrowed from bank, and that money borrowed from bank, the interest is deductible, especially when you use that money to purchase capital with which you run your business, or an owner occupy, take a loan from the bank and set up an owner occupy house. The interest is deductible. Bad debts, and so many of them. The law listed them, but they're not exhaustive. So setting the threshold of wholly, exclusively, reasonably, and necessary is good for the law to look at whatever that expense that income to find out whether it qualifies for deduction. And before we start talking about all the allowable capital allowances, that annual or initial allowances. So then it is the net income that the court, or you say taxable income, that the law will tax. Another one is realization or timing. The first example I gave, somebody bought a land, 5 million. In the next 3 months, they told you that the land is now 5.5 million. Would the law require you to pay tax on that 500,000 naira without you selling the land? The answer is no. You have to realize it. And for realization, you have to sell it. You have to dispose it off. And this is where those tax planners can use to shift to delay payment of tax. And remember that time is of essence in taxation. The more you delay the payment of your tax, the better for you. So on realization, what about if somebody, okay, I have a house, I have the same kind of land in Abuja. Somebody has that kind of land in Abuja or in Port Harcourt or elsewhere. And the person wants to buy a similar kind of land in Enugu, and you want to buy elsewhere. Both of you just change. You transfer the ownership. What do you think will the tax law do in Nigeria? I want us to discuss this, especially those who work in the FIRS. If we do such a change, what will happen? Will you say there's a realization? If you say there's realization, what price, at what amount? So timing is of essence. Now, another one is tax deferral. That's, of course, that is part of the tax deferral, to defer the payment of tax. The more you wait, the better for you. You know, and I think my time is running up. So tax deferral deals with deferring the payment of your tax. And the tax, of course, one tool to do that is to delay the subject of realization of your income. Then substance over form. Substance over form deals with issues. You could see artificial transactions that tax lawyers and accountants always come up to, manipulate the wordings of the wordings of the statutes without complying with it. So technically, if you look at it, you may say they've complied with the law, but the purpose of such schemes, the Canadians have what we call the GAR, General Anti-Avoidance Rule. So they invoke the General Anti-Avoidance Rule. There are other avoidance rules under our law, but it's the jurisprudence is not as developed as it is in Canada and the United States. So the substance and over form, they look at it, what have you done? Is there any substance in this, or just a form to comply with the law? Meanwhile, you're evading tax somehow. So the court could strike it down and say, hey, this particular plan, I refuse to buy that. Then income shifting. The shifting of income, in Nigeria here, our tax regime hasn't yet, it appears that when you look at the personal income tax, it taxes individuals. You're a married man, you file your income tax, your wife files income tax. If you look at the US tax regime, you can, if you are married, both husband and wife can decide to do what? To file. And they have different graduated tax regime for married people, for single people, and the rest. So depending on what the society wants, if you want to encourage procreation, if you want to encourage families, there are certain things you need to do. So in income shifting, for instance, I have a child, you have a child, and you know that if I leave my income to rise to a particular, that the marginal income that will come in is going to put me at a very top bracket, topmost bracket. What do? You can shift that income to maybe one of your children. Of course, you know you're in control. So tax shifting is another issue, a serious issue. Shifting your income to either your partner in Nigeria here, or to your partner. Maybe your partner doesn't earn much. Shift the income to her or your children, and this causes a lot of problems. So, but the court, there was one case I read once which said that in their court of appeal, I don't know whether that's still law, that the tax law should be liberally interpreted. That is contrary to decisions that have been held before, and in other common law countries, tax laws are strictly interpreted. Strictly interpreted. You have to be sure that this is what the tax law says, before you can now impose that on taxpayers. So now the legislature, as we know, plays a major role in enacting laws, making laws, tax laws, especially within their powers, looking at the Constitution. The executive enforces that. The judiciary, as you know, interprets that. So if there is further question on this, the part I've taken appear to be very foundational, which is the topic allocated to me by our group. I think I'm going to stop here for now. Thank you.
Thank you, Dr. Jude. I don't know if we're going to take a few questions now, so we'll just do 10 minutes for questions. So first of all, the first question is, what is the difference between an exemption, credit, and deduction?
Okay. When you say, I believe that this question definitely will be for the group when they go into the table. I will answer that. Credit, when you talk about credit, you give credit. Credit can be given to someone That is, if the law allows that, especially in international taxation. In international tax, credit or even exemption, these are instruments that are used to avoid double taxation. If you look at Section 3, subsection 1 of the PITA, it imposes tax on Nigerian taxpayer, on the global earnings of a Nigerian taxpayer. Once you are a resident, because of course in personal income tax, there are two bases for taxation, residency and source. So if you're a Nigerian resident, you pay tax on your worldwide earning. So in the world of today, it is possible that someone must have earned income in Nigeria and elsewhere. So, and other countries, for instance, in Canada, the United States, residency is still one of the requirements for imposing tax. And people could maintain multiple residencies in different countries. Or even if it is source, if you derive income from any other country, even when you don't reside there, you have to pay tax. So you find a particular stream of income suffering double taxation. It's taxed in this country and it's taxed in this other country. Now, what about, these are normally resolved through tax treaties. Tax treaties that are entered between the two countries. You say, okay, if somebody from my country earns so don't tax the person. Nigeria does not have tax treaty with the United States of America. So you could use credit by crediting that person the very taxes that he has paid elsewhere. So exemption deals with exempted income. So I think if you look at Schedule 3 of the Personal Income Tax Act, you're going to see income that are exempted. There are income that are exempted, you know, so that's exemption. What is the next term? I've forgotten. The next term?
Okay, so it was a difference between exemptions, credits, and deductions.
So, and for the deductions, generally, it is always advantageous to have a credit than to have deductions, because credit comes, you know, it affects your last, whatever you are going to, it's better to have a credit than to have deductions in terms of the effect of the tax you pay. So now the deductions, as I said, if you look at personal income tax, there are what we call the deductible expenses. It listed expenses that you could deduct. And I mentioned interest you spent on capital, which you use to run your business. There are a list of them. Bad debts are deductible. And also there are non-deductible expenses. So if you expend anything on capital, you don't deduct that, because definitely those capital are going to depreciate through capital allowances, either initial or annual allowances, which will be given to you. So that's the much I could say about that. What other question, please?
Okay, so Roland is asking, what is the current status of the tax and levies approved list for collection at
the current status of the taxes and levies approved list for collection, and which I've said here, is that it is no longer part of our law. That in your local government against Akwa Ibom State, the Court of Appeal declared that statute null and void and unconstitutional, simply because of the introductory phrase of notwithstanding the provisions of the 1979 Constitution. And that was why I said that the court made a mistake by not looking at the legislative history of that very tax legislation. Even though it could be argued that some of the subjects there are not items in the National Assembly, because that particular piece of legislation became part of our Constitution or deemed to be an act of the National Assembly by virtue of Section 315, the existing law clause of the Constitution. But the court ought to have used blue pencil rule to take off on the particular part and not to strike the entire thing down. That's my opinion. For now, there's no decision from the Supreme Court. I'm not aware whether that case has been appealed. That is the law. So that tax statute, for now, is not part of our law. That's my position. Thank you.
Okay. So the next question is, Ahmed said that time is of the essence in tax payments, and the more you delay payment of tax, the better. Please, clarification is needed on this.
Yes, when we said this, we're talking about realization.
Okay, did you hear that? Okay.
Hello?
Did you hear that, doctor? Sorry.
Yes.
Okay.
He said I should explain timing that.
Yes.
So timing this with realization. There are 6 concepts that will continue to appear in personal income taxation and company income taxation. And that is valuation issue, net income, realization or timing, tax deferral, substance over form, and income shifting. So realization deals with, you can only be taxed when you are realizing an income. And I use an example. If you buy a land, 5 million naira today, and in the next 3 months, they say that the land is now 5.5 million. That's 500,000 naira. Will the tax authority tax you for that 500,000 naira? The answer is no, because what you have is paper money. It's on paper. You have to wait until that particular money is realized. If, for instance, it's a stock, so the prices could fluctuate. Well, somebody could argue that even land as well could fluctuate, even though in practice it appeared not to be true. But let's assume that it fluctuates. Will you tax that person? You have to wait for the person to dispose it off. When you dispose it off, that is at the time the tax authority will come to say, hey, you have to pay tax on this. This is the amount you've made. Without realization, there'll be no tax. I am not aware of any particular jurisdiction that taxes income simply because the property has appreciated without selling it off. So the timing we are looking at is, the more you delay, the better. Depending, in some other countries, you find out that estate tax or maybe tax after death is, the rate appear to be lesser. For instance, you're in a jurisdiction where the rate after death has is smaller, and you decide to shift your income or bequeath that property to your son or to your child, any of your children. So there are a lot of legal issues anyway, but I know that time value of money is of essence. If you pay, for instance, the 100,000 naira today cannot be of the same value, 100,000 naira, even this last year. I'm not going to talk about 10 years ago. 100,000 naira the previous year is going to definitely be more valuable. So, but the point is that those who plan out schemes, tax planning schemes, with which to shift income, with which to delay tax, with which to avoid paying much tax, realization is one of the modes that they use by delaying the realization. That is the timing. Thank you.
Okay, just before we go on to the next speaker, Bidemi Olumide, who is a partner in AO2 Law, he's going to be talking to us. He's going to be taking the session on income tax. So we're going to just have 2 more questions before that session comes on. So the second question, Dr. Jude from Solomon says, according to the Finance Act, 7% tax is imposed on income earners earning between 0 to 300,000. How then do we arrive at a figure of 21,000 for a person that earns 200,000?
How do we arrive at what?
At a figure of 21,000 for a person that earns 200,000.
I think he didn't understand me well.
I think so too.
One, I didn't say that. You didn't listen well. One is that you don't impose 7% on someone who earns 0 to 300. That's not true. It starts from 300,000 naira up. 300,000. He said first 300,000, you impose 7%. Next 300,000 naira, you impose 11%. Next 500,000 naira, you impose 15%. Next 500,000 naira, 19%. 1.6 million, 21%. 3.2, 24. Now, there's even an issue which I am seeing in Finance Act 2020. The problem is that the Finance Act 2020 appeared to have amended, I think, Section 37 of the Personal Income Tax, which the Section 37 of the Personal Income Tax Act provided for minimum tax payable. It used to, before 2011, that the Personal Income Tax Act was amended, it used to be 0.5%. Now, after 2011, they raised it to 1.1% of your minimum tax payable. That is, if you don't, what the law says that if you don't earn up to the taxable threshold set out in the state schedule, right? Or you come up to 1%, it's not up to 1% of your earning, give us 1%. Even though the law itself has not been all that enforced. But the question, why is it there? So the Finance and Accountants provided, the 2020 Finance Act provided a proviso. And that proviso says that if you earn below the national minimum wage, or if you earn national minimum wage or below that, you do not have to pay any minimum tax. Now the question is, what is the minimum what is the minimum wage? The minimum wage is 30,000 naira. 30,000 naira multiplied by 12 for 12 months to get an annual earning of someone is 360,000 naira. So there's the need for readjustment. 360,000 is actually higher than 300,000. Therefore, one may say that if you earn anything less than 360,000 naira, 360,000 or less, you do not have to pay income tax. But however, when you read the Finance Act 2020 again and construct it critically, you may find out that it appears that the legislature gave that particular privilege only to salaried earners because you talked about employment, and that's what it's supposed to be. It has to apply across board, including those traders. But I think they meant to apply to everybody. Perhaps it was a mistake in the act. So I did not this position. Thank you very much.
Okay, so for everyone who is asking about the slides, when we're done with all the webinars for the different academies, we're going to send out the slides to everybody who registered for this session. So please be patient. When we're done with all the trainings, we're going to send out the slides to participants. So the last question before we take on the next session. So the next session is going to be for 45 minutes. And then after that, we're going to have 15 minutes for another session. So please put your questions in the Q&A section of this webinar. So the last session, the last question before we go on to the next session is, so Mohammed says, I am a civil servant who works with a federal government agency, but lives in Kano, for example. Is it appropriate for Kano state government to collect tax from me when I have tax deducted from my monthly income as payee?
Good question. This has always been the problem with the personal income tax regime in Nigeria, because the personal income tax regime, the Personal Income Tax Act, gives the power of tax collection to the state where a taxpayer resides, even though in your own case, it's not a question of residing in more than one place. So, but now, you said, he said he works in Abuja, right? Hello? Hello?
Yes, he works in Abuja.
And lives in Kano.
Yes.
How does he do the work? By virtual work?
A case scenario.
How do you work in Abuja and live in Kano? Do you fly every day? But anyway, I can only see two problems here. The problem I'm seeing is, well, you can maintain dual residency. And if you look at the first schedule of the Personal Income Tax Act, it talks about principal place of residence to resolve that. So when you have principal place of residence, then it has to be the place where you live that is closer to where you work. So in any case, I expect that you should have a house in Abuja. And if you have a house in Abuja, then the FCT, of course, you know that as from 2014, the National Assembly enacted the Federal Capital Territory Internal Revenue Act, which now created a tax authority for the FCT residents. FIRS used to collect that, but that power has now been shifted to the FCT IRS. So I assume that if you work in the FIRS, FCT, you should have a home there. But let's assume you are doing a remote work, because COVID-19 has taught us that you can stay anywhere and work anywhere. We are now talking more like this is a conference, but we're not in a particular room. People are scattered all over the world and they're participating. So you could be working from Kano. Now, using that example, looking at the personal income tax, because you're an individual, the law says that you should pay tax to the state where you reside without reference to the state where you generate the income. However, with the withholding tax system, your employer ordinarily, automatically deducts your income and send it to the tax authority where the employer is situated. That's a problem. Strictly speaking, you should pay tax to Kano, where you reside. But the enforceability of that provision is a problem. It is a problem within Lagos and Ogun State, a problem within Enugu State government and Anambra. A lot of lecturers in Nnamdi University and other people working in Anambra, they live in Enugu. But in their employers always deduct their salary even before they are paid and send it to the state authority, regardless of whatever the laws provides. So thank you, Mohammed. This is what I have to say here now for now.
Okay, so Bidemi, thank you very much, Doctor. And since you're still going to be on, by the time we come back to another session of question and answers, I'm sure you'll be able to also respond to any question that we may have. The next speaker is Bidemi Olumide. Bidemi, are you here? Please, can you come on? Okay, so Bidemi, you're going to you have 30 minutes, between 30 and 45 minutes to do your presentation, and then we can take questions if there's time. So over to you, Bidemi.
Thank you, Nta. Thanks, Dr. Jude, for the very good foundation you have laid on the topic. So I'll try to just piggyback on from where you've stopped. One thing I find fascinating with the audience so far is that it's a very informed audience. So I'll try as much as possible not to belabor you with the basics, and just try to really pinpoint the topical issues, and also use the opportunity to respond to some of the issues that might have been raised. That is relevant to my topic anyway. That might have been raised during Dr. Jude's session. My session, if you looked at the curriculum that might have been sent prior to this class, touches much on the different heads of taxes, for which we have segmented them in 4. So I'll be taking you on income taxes. One of my other colleagues will be taking you on transaction taxes. Then you also have a very detailed session on employment taxes. And then lastly, you will deal with state taxes and other state taxes and local government taxes, as it were. And now, why have we done it this way? We think that it will be a little bit much more insightful for you to see taxation, particularly from its compliance objective from these 4 prisms. And under each of these categories, you certainly, as you would see, you have quite a number of taxes. So, for example, my session on the income taxes, you see that I'll basically be talking about 7 different income taxes. I'll try as much as possible to rush through the slides so that we could have the opportunity of some interaction before I move on. Can we please get everyone to mute their phones, please? I'm getting some noise at the background, some background. So for income taxes, I think the best way to put it, okay, all right. So the very best way to put it is to understand them as direct taxes. And I'm very sure Dr. Jude had explained the difference between direct and indirect taxes to you. Its relevance, as you would see, especially when we start talking on topics such as petroleum profit tax and companies income tax, is that perhaps it's the single largest revenue earner for government in terms of taxation, and so government takes it very seriously. Yes, it's the single largest earner, but in terms of cash flow management for government, typically government might not really be looking so much at it, and probably looking so much at transaction taxes, which will be introduced to you subsequently. Why is that? Because typically most of these taxes, other than personal income tax on the payee side, are typically remitted once a year by the relevant companies. So for each, or by the relevant taxpayer. So in that case, government can only look to probably receiving the tax from the taxpayer once a year, as it were. Sometimes the payments, depending on how you manage your taxes and your compliance process, sometimes the payments you could pay instrumentally and all of that probably gives government some tax advantage, some cash flow advantage that way. But unlike transactional taxes that you either paying on the basis of each transaction, or you are paying as it were, monthly in terms of your monthly compliance. Income taxes, I mean, as I said, I mean, you basically complying with them on an annual basis. So let's jump straight to companies income tax. Okay, maybe one other thing I need to mention is that as you would see, I mean, Dr. Jude spoke extensively on the finance bills. I mean, we've had two of them so far now. I mean, in recent times under the current administration. What you find is that government, the legislative approach now to tax management or to tax legislation, as it were, is what we call the omnibus bills. So omnibus bills are bills that sort of collects, I mean, all relevant laws on a particular subject and through one full sweep amends it and gives the economy a clear, or gives society a clear direction. So one demonstration of omnibus bills we've seen in recent time is as it relates to the finance issues or the finance aspects of governance. So that's why you continue to see finance bills now that aggregates taxes, whether they're income taxes, they're transaction taxes, employment taxes, and then just through that singular legislation changes them. And we've seen a lot of this now affect some of these taxes. These 7 taxes are quickly rushed through. So companies income tax, that is, I mean, as the name suggests, is a tax that is levied on companies. Essentially, it's levied on the profits of companies. Oftentimes they're not, especially when the tax authority tries to use its deemed basis of taxation, levies it on the turnover of the company. I mean, next to the petroleum profits tax, it's the second largest revenue earner for government. It's a tax that needs to be paid by all companies. In recent times, we've seen the Companies Income Tax Act itself extended to business organizations that you ordinarily would not call a company, because our understanding of companies are probably businesses that are incorporated pursuant to the Companies Income Tax Act, particularly maybe the Part A thereof. But then we've seen the Companies Income Tax Act in recent times also extended, particularly in terms of filing obligations, extended to entities such as free trade zone enterprises, which jurisprudentially you could argue are not companies within the context of the word. So oftentimes I advise that the Companies Income Tax is whatever it taxes. So I mean, I've had arguments around the fact that why is the FRS extending the compliance provision of the Companies Income Tax to, for example, incorporated trustees, seeing that they are technically not companies. Again, I mean, there are a lot of jurisprudential questions there. Maybe one other thing I needed to have mentioned about income taxes earlier is that they are legislatively, they are controlled federally. So almost all taxation, and you can also see, you can understand that from looking at I think that should be item 59 of the first schedule to the Constitution. That's the exclusive legislative list. So all income taxes, as it were, if you are going to be taxing the income of an individual or company or whatsoever, that has to be legislated federally. It is not within the ambit of the state, even though the states have the power, I mean, constitutionally, to collect or to administer some of those taxes. So when it comes to the company's income tax, of course, it's legislated by the federal, that's by the National Assembly. The power to administer and collect that tax resides in an autonomous organization known as the FIRS. So the FIRS administers SITA. What is chargeable? What is not chargeable, rather, you could see that on the slide there. You see that the profits of a company that is engaged in ecclesiastical and charitable and educational activity is not liable to company income tax. Profits of trade union are not. Profits of a company formed for sporting activities of a public nature are also not liable. A very interesting aspect of what is also exempted are dividends, interests that you bring into Nigeria through government-approved channels. So this is really where the super wealthy, are able to maintain their wealth and pay little or nothing, in taxes, and it all comes from, effective tax planning. So if I have, I derive a lot of my income, from abroad, for example, in USD, and repatriating it into Nigeria. The company could as well be in next door, Benin Republic. Let's assume you could get some USD from Benin Republic. I repatriate it into country. That's sort of unearned income or passive income. It's exempted from companies' income tax in Nigeria currently. So that speaks to an extent. You get a lot of that. I think that should be under Section 23. We have a wide list of incomes that are earned by companies that are exempt from the CIT. One of the new fascinating additions to the Finance Act in recent times has been its clampdown, or its focus, or rather interest, on non-resident companies. Not that non-resident companies have not been liable to tax before now. In actual fact, we have a Section 55 that requires them to actually file their returns. But in terms of administration, really not so much really has been done in that aspect, either before now. But in recent times, a new regime has been created for their compliance. In actual fact, the FIRS set up the non-resident tax person's office that focuses on the administration of the taxes of both non-resident companies and non-resident individuals. But one thing that, one feature of the Finance Act 2020 is the fact that the withholding tax regime has now been extended not just to the four passive incomes of rental income, dividend, interest, and royalty, but has also been extended to professional fees, consultancy, management, and technical services fees, such that if you earn this sort of income in Nigeria, if you earn this sort of income from Nigeria as a non-resident company, once your withholding tax of 10% is paid, that is deemed as your final tax. And you need to see the tax advantage in this, particularly when you understand that the company income tax rates put together with the tertiary education tax rate is 32% of profits for Nigerian companies. I think I'll skip some slides so that we could move very swiftly. So what's the tax rate? That's clear. Dr. Judah had already explained that to you, that now small companies are exempted from companies' income tax. Medium companies and small companies are companies that are generating 25 million and below. Medium companies, you are between 25 million and 100 million per annum. You pay 20% in your company's income tax. Large companies will still sit at 30% of our profits. And what's profit? Profit is by the time you take out all your expenses, and inclusive of your expenses, inclusive of some what we call tax depreciation, capital allowances, all the way from your revenues. That line item is profit, and that's where the tax is charged. The penalty for non-compliance still remains, really wasn't changed under any of the laws. So you still pay 25,000 naira for the first month, and 5,000 naira for every subsequent month of non-compliance. So personal income tax. So the first is charged on companies, the next is charged on persons. And when you say persons, I mean, for the purpose of this audience, if you operate a law firm, of course, by the extant rules of the Legal Practitioners Act, certainly you cannot be incorporated as a company. So that means the personal income tax is what applies to you. And it's not your law firm that is taxed, as it were. It is actually you, the partner, I mean, the owner of the law firm, that is charged individually on your income. I mean, and then the law, of course, allows you to X out some certain recognized expenses. I mean, after having recognized allowances, consular relief allowances for you, I'm a bit very particular about this tax, because I think that this foundationally this should ordinarily be the foundation of any tax system. It's very easy for tax authorities to run after companies and I mean, chase after companies or chase after businesses. But then, I mean, it's people that really get to animate those companies. If the personal income tax system really can be gotten right, then tax compliance, I mean, it's in itself becomes, I mean, personally, that's a personal opinion. Tax compliance in itself becomes a little bit easier to administer. And maybe also to mention that, I mean, when we talk about this subject, you also want to look at it in terms of the business opportunity. I mean, it gives to this group. I mean, to the group of lawyers. Why is that? This is venture in compliance. Whenever you see a government that is pushing a lot of compliance agenda, I think lawyers should embrace it, because then it gives opportunity for work and for business. So I think as lawyers, I think we should be those to drive the compliance regime in the personal income tax space. Most of you might be aware, there is a requirement for compliance by next week, Wednesday. Every Nigerian, or rather every Nigerian who earns an income, is required to at least have filed his personal income tax return by next week, Wednesday. Not to do so is a criminal offense under the Personal Income Tax Act. Is there anything that stops lawyers from engaging in this space? Absolutely nothing. So lawyers can look at this, look at personal income tax returns, could give advice on it, and then either by themselves or working in conjunction with other service providers, as it were, facilitate this space. So this, for me, I think is a great revenue, has great revenue and potentials for practices, for legal practices, as it were. Taxation, again, is predominantly more law than accounting, I dare say. If you do not file, so the compliance for companies when it comes to personal income tax filing relates to their payee. So as if you are an employer of labor, there is a compliance requirement you have to meet in January. You have to meet that compliance requirement by January 31st, where you have to declare to the tax authority, I mean, all payments you have made to every person that's employed under you, all the taxes that you might have remitted to them in the prior year, there's a compliance requirement for that. Please do not mind the error on the slide. The 500,000 liability there is not just for companies, but actually for employers that do not file that returns. It's called the payee returns, annual payee returns. So that is different from the March 31st. If March 31st is the PIT returns, that's your personal income tax returns, that needs to be filed by everyone that is currently on the call, I would presume. I mean, a lot of questions have been asked on how you can legitimately reduce your personal income tax. Like Dr. Jude said, it's a graduated scale of 7% down to up to 24%. I mean, by the 2020 Finance Act, a category of Nigerians who are earning below the minimum wage have been exempted. Effectively, I mean, after you've taken all your deductions and all of that out, and probably you are earning, I think, probably earning in excess of about, say, 18 million, 15 million, 18 million. Thereabouts, you would likely be within the 19% effective tax rate bracket. You can reduce this legitimately, and what the tax system does is it punishes you when you are dealing so much in cash. So the more cash you collect, or the more cash that enters into your hand, of course, naturally, the lower the taxes that you pay. In practice, there are about 6 of them that, I mean, is used to significantly reduce your personal income tax. Don't forget the minimum personal income tax currently is 1%. So you are absolutely allowed to drive down your personal income tax payout to as much as 1%. There is no law that prohibits you from doing that if you decide to use any of the tax reduction strategies. One is it's either you want to take use of the National Housing Fund. Every payment you make into that fund is tax deductible. You might want to increase, or rather, let me start from the ones that are a little bit much more usable these days and much more attractive. One is for you to decide to do so much in your pension savings or your pension contribution. Either you're using it under the voluntary pension scheme, or you're trying to use it under your if you control the process under your monthly remittances. That can significantly drive it down. You could also decide to put some amount away into a kind of a life plan. It could be an annuity plan or something like that. It's also good. Something not on the slide that should have been here is that if you're paying interest on your mortgages, on your personal residential mortgages, you can use that interest element of that to also drive down your personal income tax. Of course, you can also make additional contributions under the NHIS, drives it down. Withholding tax credits, don't forget, when we go into transactional taxes, a lot will be explained to you about how the withholding tax system works. You want to take very good account of your credit notes. You want to have them, you want to collect them from those who said they withheld taxes from you. So you could also use that to drive your income taxes down, both on the personal level and on the corporate level. Tertiary education tax is what you call an earmarked tax. Earmarked tax in the sense that the revenues from that taxation has been earmarked for a particular purpose. In this case, tertiary education. It is only paid by Nigerian incorporated businesses. These are made clearer now that if you are a small company, you're doing 25 million or less, just the same way you're not paying your company's income tax, you're also not paying your tertiary education tax. It's a 2% rate, and it's charged on your assessable profit. The tax accountant, so will tell you that, there's a clear difference between the base on which you charge your personal income tax, you charge your corporate income tax, and the base at which you charge your tertiary education tax. So in practice, it's always remitted alongside with the company's income tax. So to the big guy in the room, that's the petroleum profit tax that generates the considerable portion of government's revenue, as it were. The rates are, if you are less than 5 years, first the tax itself is levied on your petroleum profits. So it's very possible that for an organization, it can be paying petroleum profit tax. That's the profit that comes from its petroleum operations. And then at the same time, still be liable to company's income tax. That's the tax, the income or the profits that comes from every other thing other than petroleum operations. The rates, if you less than 5 years, you're doing it at 65.75. If you are more than that, you said you're not doing it at 85%, except if you are under a PSC arrangement with the NNPC of government, where you do it at a flat rate of 50%, again on petroleum profits. While I spoke about on companies' income tax, this also applies, and that's the fact that it's particularly when you're trying to determine what eventually constitutes your profit. I mean, in terms of the expenses you can really back out of your revenue, I mean, the test the tax authorities will typically use will be the rent test that is only reasonably, exclusively, and necessarily. I mean, that expense was incurred for the purposes of your profits, whether petroleum, whether non-petroleum, as it were, under the company's income tax. Some of the interesting things that have happened in recent times with the FRS has been arguments around if you were required to have a particular license or so, and then you do not have a license. I mean, one very interesting example with me is something like the NOTAP license, particularly for the remittance of some foreign outflows. So some argument that come that, oh, if you're required to have a NOTAP license for you to be able to expense some payments to maybe your foreign vendors or so, and you do not have it, I mean, the FRS are dead come up. Then we're not going to allow such an expense. But then the costs are consistently maintained. I mean, in recent times, I know the rent test is what applies. Whether that expense was only reasonably exclusive and necessarily incurred. The non-obtention of, say, for example, a NOTAP approval, which by in itself it's not a penalizable offense, or it's not even an offense in itself. If you decide not to have it, is not a condition for the tax authority not to recognize a particular expense. So we still continue to hold on to the rent test as being that statutorily approved test for the purposes of recognizing expenses. Timeline for payments, like I said again, it's an annual payment. The penalty for non-payment is at 5% of, because the tax itself is paid on an estimated basis, and so basically you're paying it, I mean, every two months. I mean, to government on the basis of calculations, I mean, that have been given to government prior to the particular year of compliance. Capital gains tax, interestingly, it has also taken the forefront also under the Finance Act 2019 and 2020. So some attention is now being given to it, particularly in terms of its compliance. It is charged on disposal. It's charged on capital gains, and those are gains that you make from the disposal of what you call chargeable assets. Chargeable assets, assets that are recognized under the Capital Gains Tax Act by itself. It's a rate at a 10% rate. Now, this tax is just like the personal income tax, particularly under the PE system and also under the PIT system, is of great attraction to state governments, because I mean, this is where they get a lot of revenues. I mean, for example, your typical land transactions always have a CGT element, and so states are always a bit very interested in this. And the CGT currently does not, it is inapplicable to gains from the disposal of shares. So if you're trying to avoid CGT, probably you want to keep a lot of your assets, or you want to keep a lot of your assets that you intend to dispose of eventually, really in the corporate structure, whereby you are able to actually dispose them of through the sale of shares rather than the sale, I mean, of the assets. Again, it really focuses on the gains that you make on assets, on the disposal of assets. NITA levy. This was introduced in 2007. It's also an earmark tax because the purpose of the tax itself was it's reflective in its name. The organizations that are liable to pay for it, it doesn't apply to all organizations. So you'll be looking at the financial services industry, the banks. You'll be looking at the ICT industry, the fintech companies, and so they are the ones that pay. And then in each of them, they should have an annual turnover of more than 100 million. The rates for this tax is at 1%. And then, of course, the proceeds, it's administered through the FRS, but then the proceeds eventually sits with NITA. And NITA is the Nigerian National Information Technology Development Agency. So the list of the organizations that are liable to pay the levy on my screen. Okay. So let's quickly run to the last, which is the newest baby in the income tax space. That's the Nigerian Police Trust Fund levy. It was recently introduced by the Buhari government in 2019. It is at a rate of 0.005% of the net profit of companies that operate in Nigeria. Essentially, it's more like a security trust, security levy, as it were, on companies. The law itself was non-committal as to the basis period. The year of assessment from which it becomes really operational. But then in practice, what we basically assume is that it became operational in June 2019. So we expect that currently the practices that look only in income starting from 2020, as it were a full year income, would we surcharge with the police trust fund levy. In terms of its administration, we're yet to see some full enforcement. The communication that we expect, particularly for an administration of a tax, we're yet to have it, and we're yet to get it from the relevant authority. But then, it's police money, so I guess we also want to think that they're going to take it seriously eventually. I intended to finish at 3:45. I am 1 minute late. So I think I will leave the floor now to take questions for the next 15 minutes. Thank you.
Okay, thank you, Bidemi. So I'll just start from, I'm mindful of our time because we have it 4 p.m. So I'll just start from where we stopped from the last questions. So most of the questions are actually from actually going to be referred to Dr. Jude, but let me just see here. Okay, so the question said, yes, please can you clarify whether a limited company can pay stamp duty on a real estate transaction to a state internal revenue service or FIRS? Bidemi, would you be able to take that? Okay.
All right, that's fine. So your stamp duties, if it's a transaction between companies or a transaction between a company and an individual, typically your stamp duty is payable to the FIRS as a federal Inland Revenue Service. If it's a transaction that involves individuals, it is payable to the state. So it's a question of the parties. I don't know whether that answers your question.
Okay, so the next question, Yomi is asking, why do we have several laws covering different tax levies? Why can't we have one law that will cover all tax provisions? I don't know if it's a question. question we can take on this webinar, but please go ahead.
It's because it's the law. That's how the laws are structured, and dare I say that I think our tax laws, I mean, compared to, I mean, the more advanced the economy, more oftentimes than not, the more complex the tax laws. Clearly, our tax laws are not as complex as what you're going to have in jurisdictions like the United States. So I think we're doing pretty good with the laws as it were. And then when you see the new dimension with omnibus bills, or rather omnibus finance laws like the Finance Act, clearly then we have them all put in one place. And then with that singular legislation, we can know what direction the government and the economy intends to go in any fiscal year.
Okay, so the next question is, sorry, just bear with me. So there's a question is a law firm which is registered as a business name, not a company, mandated to pay tax, or does the personal income tax of the owner of the firm suffice for this purpose?
Sorry, I don't know what you mean by the law firm is registered as an investment company.
No, as a business name. Sorry, as a business name, not a company.
Okay. Sure. Law firms are expected to be registered as business names. So the tax is administered in the hands of the partners, the owners of the law firm. Okay. So I think that pretty answers it. So it's expected that the partners and the owners of the law firm will file their personal income tax returns on or before the due date. And again, the due date for filing personal income tax, the 2020 income tax is Wednesday next week. So please, yeah, and you're basically going to be filing it in your state of residence. I think a question had been asked Dr. Jude earlier, particularly as it relates to itinerant workers. Typically, those are people who may work from state to state, but then I think a very simple way of doing it, and just makes life a little bit very easy for you, is probably to just, because you have an option of either filing it in your state of residence or in that state where you predominantly work. And I think the rule is about you work an average of 20 days in every 60 days. But just to make your life easy, I think you should just file it where probably your family abode is, or you live, as it were.
Okay, so the next question is an incorporated trustee that engages in a trade stroke commercial activities liable to pay CIT?
Sorry, the question again, please.
So did you hear the question? I should read it out again.
Please read the question out.
Okay, is an incorporated trustee that engages in a trade stroke commercial activity liable to pay CIT? That's company income tax.
Okay. So I'll say that an incorporated trustee, I mean, of course, that earns income, I mean, from a trade or business is liable to pay income tax. Now, whether it is CIT or whether it's PIT is another conversation altogether. Typically, because the CAMA, I mean, it's a federal legislation as it were, what we typically have is that the FRS tries to snoop in that space. Personally, I think that the tax should be probably administered in the hands of the trustees that constitute that incorporated trustee, and accordingly should be payable to the states. But then I think the jury is out on that question, and I'm very sure some of my colleagues are here. If Folajimi is on the call, I'm very happy to also get his, sorry, if Folajimi is on the panel now, I'm very happy to hear his perspective too on the issue.
Yeah, Billy, if you're asking to whom incorporated trustees pay taxes to, I guess that was the question.
Oh, yes.
Incorporated trustees, you know, they are supposed, if they carry out revenue earning business, so who they pay the taxes to?
So we've had a couple of there's the I can't remember what school exactly. There's that school that sued probably FIRS to court. I think the question in that case was whether the school, by virtue of how it was created, should be subject to tax. By practice, usually schools will be set up as incorporated trustees. And the issue in that case was the school was set up as a limited liability company, and for that purpose, should pay taxes to FIRS. But yes, I align myself with you on BDB. You would think that trustees would be regarded as being liable to the tax itself as opposed to the entity. But again, yeah, I guess the jury's out on that as well.
Okay, so we have just 5 minutes before the next session. So Olumide, Bidemi, this is actually directed at you from Ifoma. She's asking, she'd like to know if the progressive tax rates for income tax is chargeable on gross annual income or monthly income. Then she also asks if on a pay scheme, a company remits the tax to its employees in its branch office in another state to state where the corporate office is situated, can the taxing authority in the state of residence of the employee sue the company for non-compliance? Then she asked another question. Also, can the company request the tax authority that received the payment to transfer the remittance tax payment to the tax authority of the residence of the employee? So I think there are 3 questions in one, and that should, wrap us up for your session. Or do you want me to take the questions again?
Please do. I'm not as smart as you think.
Okay, so we'll start. The first one is, she would like to know if the progressive tax rate for income tax is chargeable on gross annual income or monthly income. So let's start with that.
Okay, yeah, so it's on gross. In terms of the calculation, it's best for you to calculate it on gross, and then you can then annualize, or rather you can then maybe probably for purposes of PE management, you could then divide it into the relevant months so that you know what is payable monthly. But you need to also be very careful. How it typically is administered is, and this is speaking on the payee level, because I think all your questions are probably coming from a background of a company. So I just assume that probably you're looking at it from a payee point of view. So how typically you want to do it, or rather what the tax authorities, efficient tax authorities might do to you is to give you what should be deducted and remitted to them monthly from your employees' emoluments or salaries. Now, that sometimes is not always correct, because sometimes the employee might leave what we call early leavers, or the employee might join you in the course of the year, what we call late joiners. So the rate skews sometimes in that regard. So what you typically want to do, and that's where your annual payee returns becomes very relevant, because then you now annualize all the payments, put it through a tax table. You could get, there are a lot of apps currently in the market where you could easily do this computation. So just analyze it on that app. Then you know what ordinary should have been paid, on an annual basis. Again, to simplify my explanation, if you pay on a monthly basis, there is that risk that you might have either underpaid or overpaid. So you need to subject it to an annual tax table, because what the law actually provides for is an annual computation. For the purposes of tax administration, some tax authorities try to push you to do a lot of monthly computations. They tell you they're prorating it and all of that. Sometimes the prorated amount does not equal what the annual figures should be. So the next question, please.
Sorry, before you go on, let me comment, because I can see some comments. So incorporated trustees by nature are set up as non-for-profit entities. So generally, you would expect that they will not earn profits. And it follows that for that reason, they would not be subject to taxes. However, we've seen instances where incorporated trustees go outside their objects. And I'll give a classic example. So you have a church, for example. A church is set up usually as an incorporated trustee and carries on the business of the worship of God. For those reasons, no taxation. But in the same instance, the church could have a hall, right, where it leases or rents out for ceremonies, and it earns a revenue for that purpose. Now, because it rents the hall to different people, and that activity is not necessarily tied to its core objectives of a religious type, then it's any income it earns on those on that activity will be subject to tax by FIRS. So I just wanted to clarify that point. Again, to summarize, incorporated trustees by nature are non-for-profit, so you don't expect them to pay taxes. But when they venture out of their core objectives and earn an income and make a profit, then they'll be subject to tax by FIRS. I hope I clarified that. Thanks.
Yes,
okay.
You did.
I don't think you need to repeat the question because I think I can see it on my screen. So
yes.
I think the question was on whether if you had wrongly underpaid personal income tax to a different tax authority, can the tax authority, which should have legitimately earned that money, sue? I guess that's the question.
Yes.
So I mean to answer it very simply, yes, they can sue, but then it's just very important for you to notify them that the taxes have been paid to another tax authority, and they'll also notify the other tax authority. Interestingly, that's one of the things that, I mean, in recent time in practice, really, the JTB really doesn't descend into that arena, but that is one of the reasons why the JTB is set up. And then I think I can't remember the provision, but it's one of those provisions between Section 1 and Section 10 of the Personal Income Tax Act, which makes it that if you might have paid the personal income tax wrongly, if the fact that you have paid the personal income tax to a particular tax authority should not be a reason. I'm trying to paraphrase how it is put, but I think the context of that provision is that the tax authorities should be able to speak to themselves and settle their accounts. But again, I mean, this is where a good corporate communication in terms of explaining what's happened and all of that is passed on, I mean, to the relevant tax authority. So, I mean, personally in practice, you're not going to pay the tax twice. It's been paid, and the tax authorities should be able to speak to themselves. It's one tax law, the Personal Income Tax Act, which is a federal tax statute, and the administration of that tax law itself is statutorily also placed within the JTB. So the JTB, that's a joint tax board, which is an aggregation of the FIRS and all the 36 states inland revenue services. I mean, that's the board where they all play. Should be able to resolve that very, very simply.
Yeah, but can I come in here? It's not that straightforward. It's not. Yes. In most cases, either the state or especially when it is between a state revenue and the FRS, the state will insist that you have to go and collect the tax you have wrongly paid to FRS and settle them, and the FRS or the other state revenue will not even listen to you because each state want to get the lion's share of the revenue and may have to frustrate you as much as they can to ensure that you don't get that tax back. I have a personal experience. I think I explained this to you some time ago. It was very, very difficult. In fact, at a point, I wanted to sue the state that the tax was wrongly paid to and the FRS so that the parties can claim, establish their right to the tax equation.
I want to think that your case was that I guess it was a case of withholding taxes that you have
exactly,
and giving to federal and giving to state. Okay, I mean, I want to believe that it's the same principle that applies. Although the question of the participants, I mean, relates to personal income tax, which I mean, as between states. I do not see a reason why you want to pay the tax twice, especially when it's administered under the same law. In the case of the personal income tax, there is actually a provision. I'll be jumping off the call, but then I think I mean that provision will be shared
you are right.
The chat box and all of that actually provides.
All right. Exactly. Yeah, thank you.
Thank you so much.
Thank you, Bidemi. So we're just going to go to the next speaker. Steve Arubike is a partner in GLIS and GLIS. Steve, if you could just put on your camera, the floor over to you now. And so the session is actually for 3 hours. It's actually for 3 hours. So we're at the last leg of the session. So 45 minutes so that we can take questions for 15 minutes. Thank you, Steve. Please go on.
Yeah, thank you very much. I thank the previous speakers, especially Dr. Jude and Olumide. I mean, they've made my work pretty quite easier. They've taken some of the topics that I supposed to speak on. Especially as you can see, I'm going to talk on basic concept in tax, and I think Dr. Jude has actually handled some of the basic concept.
Yes, but, Steve, your camera is still off. Please, could you just put it on? Yes, now.
Can you see it?
No, I can't see it yet. Yes, now. Perfect. All right, please go on.
Yeah, okay. I'm very sorry for that. So like I said, Dr. Jude has said the ball rolling by, taking a look at tax and some of the fundamental issues. So we are also going to take that a step further by, digesting or treating some of these concepts in detail. So it may take me about, say 30 minutes to do this, and I will entertain your questions. So the first the approach will be to look at tax, the component of tax. I also look at income and capital. That drawing a distinction between income and capital. We also look at the 3 definitions of income. I look at the tax reliefs, applicable in Nigeria. Basically, the deduction, the capital allowances, the exemption, and the tax credit. And I recall that somebody asked a question about the difference between tax deductions and the tax credit. Maybe after this lecture, the point will be clearer. I also take a look at tax avoidance and tax evasion, trying to draw a distinction between the 2 terms. And we also finally look at tax audit and the tax investigation. Just a minute. I'm trying to share my slide, but I will keep speaking. And
yeah, Steve, we can actually see your slides. I can see your slides, so you just have to.
Okay, you can see my slide.
Yes, I can.
Okay, very well. So we are going to look at tax, and as I mentioned, we are going to dissect tax. Unfortunately, no statute in Nigeria defines the term tax. But from the definition given by Dr. Jude, we are going to see some basic component of tax. First, it is a pecuniary burden, imposed by government, otherwise as a punishment or service charge. So from this definition, the first thing you observe is that it is a burden. It is not something that you do voluntarily. You can actually give money to government, but when it comes to tax, it is actually imposed in the sense that you have no option. You must pay your tax. It is law. Once there's a law, that have been duly passed, imposing tax on an individual or an entity, it must be complied with, and there's a sanction that goes with failure to comply with that. So it is imposed. One. Secondly, by who? It is imposed by the government. Now, when I say it is imposed by government, that means if the entity, asking you to pay or compelling you to pay money is not a constituted authority, it is not tax. Maybe an area boy can block a street and ask people to pay money. It is not tax. Your church can, ask you to make an offering, or your community can ask you to pay money for developmental purposes. That is not tax. Now, even though tax it is imposed by government, it is not every pecuniary burden that is imposed by government that qualifies as tax. I'm going to draw a distinction here because if government impose a fine for violation of law. Let's say you attempted or you have been driving along the BRT corridor and LASMA, apprehended you and have asked you to pay 50,000 naira. It is a fine for law violation. You can also, another distinction is where there is a provision in the criminal law, imposing a fine, imposing a penalty, maybe a monetary penalty for law violation. That penalty.
Sorry, Steve. So participants are saying that your slide has not been moving, or you're still on this front.
Yeah, I'm actually, I thought you are saying, okay, I'm coming.
So you haven't moved.
I'm coming. Can you see the slide? I
can see the first page, which is basic concept of tax, but then okay, so now it's moving.
Yeah. Okay, sorry. So now looking at the slide, you can see I have fine, penalty, and forfeiture. They are not taxes. Because these are imposed by the government. Fine, I've given an example of fine. Penalties under violation of a criminal code, that give you option of fine or imprisonment and fine together. I mean, such penalty will not qualify as tax, even though it is imposed by government, because they are imposed as a punishment for violation. Forfeiture will not also qualify as tax. For instance, you have been hearing about EFCC, getting a court order for someone to forfeit asset or to forfeit money in a bank account. It is not such a. If it is such a forfeiture, those people will not qualify as tax because they are imposed as a punishment for violation of the law. Now, and a gray area is whether service charges qualify as a tax. If you have to pay service charge to government, is it a tax? No, although sometimes the line between tax and service charge may not be very clear. Let me give you an example. If you are filing a writ of summons and statement of claim before a court, any other processes, you may have to, pay filing fees. You say, is that filing fees? That no, it is not, because there is a service that government is providing, and you are paying that filing fees or paying money to obtain certified true copies of court process as a service charge. But you find out that in some cases, the amount being paid as service charge may be so high that, and you may have to pay it as a percentage of, as a percentage. Let's say CAC filing, or you are filing charges as Corporate Affairs Commission, and you have to pay, for registration of charge. I mean, because of the magnitude, you are paying, you are registering charge, let's say, for amount up to 1 million, 2 million, sometimes 100 million, depending on the consideration in the charge document. I mean, in that case, you can say the person paying it is paying a tax. So the line between service charges and taxes may not be very clear. No, the reason why you need to determine what is tax or not, because when it comes to tax, it must have been imposed by the appropriate authority. For instance, you can all the courts use the provision for filing in the court are made by the judges, and of course, a judge cannot impose a tax. That's very simple. And if what you are paying is a tax, you have to look at. You have to consider whether it is the appropriate authority under the Constitution or other law that that has imposed the payment as tax. So that will take us to a very important aspect of this. What is the processes involved in tax payment and collection or taxation generally? Now, there are 3 steps. As you can see from the slide, we have the imposition, the assessment, and collection. What we have here is that tax is effected in 3 stages. The first stage is to a declaration by the law, the subject liability by imposition. That's the law made by the appropriate authority, be the National Assembly or the State House Assembly within their area of authority. They can say it is always the Parliament that that impose that it is not the legislature, it is not the executive. That's why you can see there's a recent case involving the Minister of Finance, prescribing, amending the tax law as it is under value-added tax, and they call it invalid because the minister has no power to impose tax. It is the legislator that is authorized to take that first step of imposing, making the imposition. Then the second stage is the quantification of the liability by means of an assessment. That is determining how much the subject, how much the taxpayer will pay. In that instance, that is by means of assessment. Now, assessment, as I think Bidemi mentioned it in passing, assessment here, we have what we call self-assessment in Nigeria, whereby you can assess how much you're supposed to pay as income tax, either personal income tax or company's income tax. You do a self-assessment, but your self-assessment may not be accurate or may not be accepted by the tax authority. So the tax authority can, do a revised assessment or further assessment as the case may be. And if you have not even assessed yourself, they can assess you on a basis of judgment assessment. So that second stage is exclusively the function of the executive arms of government through the various tax authority, be it FRS or the state revenue authority. Then the final stage, you now ask, final stage take us what happened in case you have been assessed or you're supposed to assess yourself and you refuse to pay. Would they just leave it like that? No. That takes us to the third stage, which is the recovery or collection of taxes. And the recovery and collection process is actually being carried out by both the executive and the judiciary. Now, if you fail to assess yourself or you have assessed and there have been assessment made and you fail to pay, the tax authority will take further steps to recover the tax. They can write you, write you to explain why you have not paid your why you have not paid the assessed tax. And if you still fail to pay, they can take further step by they can sue the defaulter. They can restrain the assets of the defaulter. They can also they can also compel an agent who is in possession of your fund to pay that tax on your behalf. So that is the third and the last stage, which is the recovery process. So like I say, it is actually the functions of both the executive arm and the judiciary. If you read this case of Wando Supplies and the FI, you see the court making pronouncement on these three stages. Well, I will not talk about the division of the taxing power as it has already been explained by Dr. Good. But one thing I must point out is that payment of tax is not a moral obligation. The motive is not relevant. You must pay your tax, whether or not, whether you like it or not. Like you say, it is imposed. So the morality or the motive of the government is not really relevant in paying on whether or not to pay your tax. Of course, morality or motive of the government may come into play when it comes to compliance or what we call self-compliance. But if you fail to comply, and if you fail to comply, the tax of the relevant government authority can compel you to pay tax, whether or not the government have even decided its own responsibility in providing the necessary infrastructure or putting the necessary machinery in place to cushion for the welfare of the citizens. So this will take us to the next, to the second concept. We're going to look at the concept of income and capital together. We start on the premises that tax is not imposed on capital, it is imposed on income. And now for us to understand this, I will use an example to draw the distinction between income and the capital, because sometimes it may be difficult. Let's assume that the company A, raise money through public offer and put that money in a bank account, and at the end of the year or after the end of the year, the tax authority come up with a claim that the tax that company has paid is not enough because they saw 1 billion naira in the bank account. Can the tax authority tax that shareholders fund? No. because the shareholder fund is shareholder fund in the bank account is purely capital. You cannot tax capital, you tax income. Now, for you to understand this, the court have employed an analogy to differentiate between income and capital. Now, the court, the analogy is that the capital is like the tree, while the income is the fruit or the food crop that you derive from that tree. And of course, if you decide to go after the tree, you can't get the fruit. So that's why tax is always imposed on income, not capital. And of course, if you look at this, the English case of Mallet and Stavely Coal and Iron Company Limited, you're going to see that distinction in operation. And in fact, recently, a case in Nigeria, in fact, use this concept of income and capital to determine that there are an assessment made by FIS based on the value of property of a taxpayer, is not a turnover assessment. Now, let me explain. Under Section 30 of Companies Income Tax Act, if you fail to pay tax, the FIS is the FIS or the relevant tax authority has the right to impose tax based on your turnover. Now, what FIS did here is that because the company has assets in Abuja, they use the asset to, they determine the value of the asset and now ask the company to pay a percentage of the value of the asset as tax. And the court say no, you cannot tax, even though the FIS has the power to impose tax on turnover where the taxpayer have failed to assess and pay tax. You cannot base such assessment on the value of the taxpayer's asset because the property is qualified as capital. So if you can actually tax, you can actually tax the rentals from the assets. So you can see that while the property itself qualifies as capital, the rent you derive from that property qualifies as income. Now, in the absence of definition, in the definition of income, you can always see references in the respective tax law on what is income or what qualifies as income, like dividend from investment, rent from business, emolument from employment. Emolument is income. Dividends are income, rents are income, and you are deriving this from employment, from investment, and what have you. So income, Bidemi has already, given you a brief background on income taxes, and there's no need to repeat that. So we are going to look at the next set of concepts: the taxable income, assessable income, and total income. Now, when we say taxable income, we are looking at that income that you can actually tax. It is not all, you cannot subject all income to tax. There are some income that could be taxed, there are some that could not be taxed. So when we say taxable income, we are talking about that income income of an individual or a company that the government has the right to impose tax on. So that is actually what we call taxable income. I'll give you an example here. We have wages, we have salaries, we have bonus, gains, investment income, and others. There are also examples of income that the authority has no right to tax. We have the frank investment income and interest on federal government bond, but the interest in your bank account or interest accrued on a loan, will be taxed as withholding tax. We'll come to that later. Now, let's move ahead to assessable income. What is assessable income? Now, for you to arrive at assessable income, you have to look at the total income of the taxpayer by considering the gains and the losses record. That is the income. It is the income of the taxpayer, less allowable deduction. I'm going to take you through allowable deduction so you understand what it is. But it is just like when if you have derived income, those income that could be subject to assessment those income that the tax authority can actually assess and ask you to pay is what we call a assessable income. But for you to arrive at the income that can actually, that a percentage will be applied, there's also further steps will be taken by arriving at the total income. That is assessable income of a taxpayer from all sources, less from all sources in a particular year of assessment, including balancing charges, but less capital allowance and losses. So that is the total income. So you can see it is, even though you have a taxable income, some certain adjustment will be made in the process to arrive at the income that you can actually say apply the 30% in respect of company income tax. It is income tax at or 2% in case of education tax. So you have to arrive at the total income by taking into consideration balancing charges, capital allowance, and the previous year's losses. So that is about income, and we are going to look at some of the reliefs that government grants to citizens, to ameliorate the impact of taxes. So there's always a policy reason that you don't pay tax on, you don't just pay tax. Sometimes government consider some certain things, grant some reliefs, either as by way of deductions or allowances, exemptions, or credit in the process. So we are going to look at these reliefs. Now, the first relief is the deductible expenses, and I think Bidemi has touched on deductible expenses in passing, but we are going to look at it in more detail. So now, the deductible expenses refer to the business recurrent expenses that are deductible from the total taxable income before you actually, consider the tax that the taxpayer will pay. That is what is implied is that if a company, I would like to use the analogy of a company because that makes pretty more sense, because a company always incur expenses. If a company, let's say a laundry operator, incur expenses, they say both must have paid his rents, must have paid for the water, detergents, and perhaps NEPA bill in the and at the end of the year, the income, the actual amount in the bank account may be, let's say, 50,000 or 100,000 naira. You have to you have to reduce the actual amount by taking into cognizance the expenses that business entity has incurred, before you actually arrive at the income that will be subject to tax. So what are the conditions? Now, the first thing is that you don't include your personal expenses or expenses of capital nature in arriving at a as because you don't say them, you don't deduct them as expenses. That is what is captured in what we call RAIN test. The expenses must be wholly, it must be reasonably, exclusively, and necessarily incurred in deriving that taxable income. So you have to look at the item of expense equation to confirm whether it has satisfied the RAIN test. Without satisfying the RAIN test, it will not constitute a deductible expense in the hand of the company. That's number one. The second is that that expense must not have been disallowed under Section 27 or CETA. Section 27 or CETA explicitly set out non-allowable expenses. So even though, well, you may think it's wholly, reasonably, exclusively, or necessarily incurred in deriving the income, but under Section 27, it is explicitly, stated to be disallowable. You cannot deduct it from the income. So that's pretty much. So we have when you look at Section 27, you are going to see the non-deductible expenses. While the rent tax criteria that I just mentioned is set out in section 27 of companies income tax. As a basic rule, the expenses of capital nature does not qualify as deductible. But the question is, does it mean that when you incur expenses of capital nature, there is no relief at all? No, that's not the case. That will take us naturally to capital allowance. Now, I've given you an example of a laundry operator. You know, I've given you the expenses that the laundry operator can incur, which are just recurrent expenses. Now, the question is, what about the machine, the laundry, the washing machine? What about the iron? What about the either the bike or the canapé for deliveries? Does it mean that government will not even give you any relief for that? No, that is not the case. Those expenses, as you can see, the iron, the washing machine are expenses that you have incurred, but the lifespan of the assets will last for more than a year. So the basic rule is that when the lifespan of an asset, when the lifespan of a particular item that you have procured to run a business will last for more than 1 year, it will always be capitalized. And that's what we call capital allowance. That's when the tax benefit of an expense related to a period exceeding 1 year, the expenses will be capitalized and deducted ratably. So what normally happens is that you break down the expenses throughout the lifespan of assets, and you can claim it in accordance with the second schedule of CETA. So capital allowance is not actually granted in all it's not granted. It's not all assets that qualify for capital allowance. So you can see under that second schedule that it listed the assets that could qualify for capital allowance. Now the next is exemption, tax exemptions. We have also mentioned this in the previous session. So what is tax exemption? The tax exemption refers to the removal of certain income from the computation of total taxable income. So in essence, it will lead to reduction. It will lead to natural reduction of the taxable income. Well, if you look at the definition of taxable income that I have given you, what it suggests naturally is that there are non-taxable income. So those non-taxable income are the tax exemption or tax exempted income. So I have tried to classify the tax exemption in categories. We have those that have a foreign element, like a foreign source dividend, interest, rent, royalty, brought into Nigeria through the approved channel. They are exempted. You don't calculate them or you don't tax them. Interest on long-term foreign loan, although the section that provides for interest on long-term foreign loan has been amended by Finance Act. You can't claim everything. Before, if the long-term foreign loan is up to 7 years, you can get a total exemption. Then interest on foreign currency domiciliary account is not subject to, it's exempted from tax. We have double taxation treaty that exempts some income from, that exempt some part, a percentage of percentage of withholding tax from in relation to investors from double taxation treaty countries. I mentioned some of the double taxation treaty. What this means that if the investor, somebody who invested in, say, shares of a Nigerian company is from any of the listed countries, there will be a reduction from 10% to 7.5%. So that's an exemption. We have exemption granted to companies in the priority industries. Profit of a company and dividend to each shareholder within the pioneer period. Those that have gotten the pioneer, that have been granted the pioneer status, the income will be, subject to, will be exempted from tax. We have also investment income, dividend received a net of tax. Net of taxes like rent, interest, royalties, and other distribution to shareholders will not be taxed again in the hand of the shareholder. As you all know, before you receive your dividend, a 10% tax will be imposed on that dividend. In essence, you are receiving 90 of the 100, 10% being withholding tax. Now, in the hand of the respective shareholders, that income will not be subject to tax. We have also mentioned, I think, in the previous session about not-for-profit organization. Now, income from approved charitable organization, approved, not all charitable organizations will not be subject to tax. Educational institution, of course, we also mentioned something relating to that. Approved government educational institution. If you organize that educational institution as a public, as a limited liability company, it will be subject to tax, but as an incorporated trustee or company limited by guarantee, it will not be subject to tax to the extent that the income is being used purposely for the object of the educational institution, cooperative society, religious body, company formed to promote sports, expenditure on the development of social infrastructure and profit of companies established by state law to foster economic development will also get tax exemption status. Now, the last one is tax credit. I think somebody asked a question regarding tax credit when Dr. Du was delivering his lecture. What is actually tax credit? Tax credit is a direct alert, a direct amount of money that the taxpayer are permitted to subtract directly from the tax, the actual tax that the taxpayer is supposed to pay. So when we say tax credit, you are claiming it directly from the actual tax. That is, if you have been assessed to pay, let's say, 1 million, and you have a credit of 100,000, you end up paying only 900,000. So tax credit goes to the actual total amount you are supposed to pay as tax to reduce, it will reduce the amount. So let us look at some of the examples of some tax credit in Nigeria. We have the withholding tax credit, which you all know. When a payment due to you or due to a taxpayer has suffered a deduction by way of withholding tax, you get a credit. You get a credit to the tune of the amount deducted. So at the time you are to account for your tax, that amount, that credit has to be settled from the actual amount that you are supposed to pay. You also have a foreign tax credit. We also have credit that could arise as a result of overpayment of tax. So what happens is that you have to deduct it before you pay your tax. And of course, like I stated here, the relevant tax authority will always like to, if you are claiming tax credit by overpaying tax, they will not naturally agree with you. They will subject the relevant taxpayer to tax audit to determine whether you actually earn the credit before granting such a credit. So what is the difference between tax credit and deduction? Like I said, deduction, exemption, unlike a deduction and exemption, tax credit will actually reduce the actual taxable income. It will reduce the actual tax amount, not just the taxable income. But when we say taxable income, we have not determined the tax, but we are just looking at the income that will be subject to tax. But in the case of credit, the actual tax amount will reduce to the amount of credit you are entitled to. So in essence, tax credits are more favorable than tax deductions. Now, we are also going to look at another concept or two concepts. tax avoidance and tax evasion. Because you have been hearing about tax avoidance and tax evasion. So what are we actually talking about now? Tax avoidance is minimizing taxes by using, method permitted under the tax law, to reduce the actual tax. And it's legal. It includes legitimate tax deduction. I think Dr. Jude mentioned that tax deferral, where you instead of paying tax, you can, by design or plan, you are paying your tax in 10 years time. Of course, money you are paying your tax in future. Of course, it's a way of avoiding tax. You pay the tax eventually, but you have enjoyed something. Employee tax retirement plan. I think Bidemi also mentioned it in the course of the lecture. So we have also other tax planning techniques. So when you employ these tax planning techniques to reduce the taxable income, to reduce the amount of tax you are due to pay, we call it tax avoidance. So you can is actually sanctioned by law. This case of Inland Revenue Commission, the Duke of Westminster actually says that every individual or taxpayer has the right to employ all the available means or design under the law to reduce your tax. If you can do it and do it successfully, and you don't even have any tax to pay, it's legal. It's not a moral question. Some people can, may say it's immoral, but from a legal standpoint, you have not violated the law. You are still within the law. That is tax avoidance. Now, what about tax evasion? Tax evasion is not paying taxes at all. Underpayment of taxes, failure to remit tax that you have deducted. Persons and the government and the entities are obliged under the law to deduct withholding taxes regarding payment to another entity, or you may also have to, you may deduct, you may collect VAT from a service from an entity, and if you decide to keep the money that you have deducted without remitting it to the relevant tax authority, it's tax evasion. It also includes not reporting income. You report, for instance, you are an employee, but you have sources of income outside your employment. You have to report it and pay tax on them. You start reporting more expenses. It should be expenses, not expenses, please. Correct. You are reporting more expenses than you actually incurred, because of course, when you have more expenses, it will reduce the total, it will reduce the taxable income. So you decide to report more expenses to reduce your tax evasion. Not paying, underpaying tax, or manipulating accounts to show that you are not liable to pay huge huge amount of tax. I mean, accounting, not paying even CGT on assets disposal constitute tax evasion. That is not tax avoidance, because these are what I've just mentioned are disallowed under the law. So tax evasion also constitutes a criminal offense. You can look at section 92, 94 of Companies Income Tax Act, section 95 to 96 of Personal Income Tax Act, and section 40, 42, 43 of Federal Inland Revenue Establishment Act. These sections, made tax evasion criminal or great criminal offenses for evading taxes. The next and the last concepts are tax audit and tax investigation. Now, start with tax audit. Tax audit simply means examining the record of and documents of a taxpayer to, determine whether the taxpayer has paid correctly they assessed or has reported his or her income or have fulfilled all the obligation imposed under the law. It is a routine process that the tax authority is supposed to conduct on taxpayer, because even though people pay tax voluntarily, but that doesn't apply to everybody. Somebody may decide not to pay tax for one reason or the other, or may decide to underpay tax. How do you determine whether the entity or the person has not paid tax or has underpaid tax? It is through the process of tax audit. It is always, like I say, is routine. Review process involved is examining the issues regarding the accuracy of tax liability or even the account declared by a taxpayer. Now, as a matter of law, under the relevant income tax, there is a limitation period for tax audit. That is to say, the tax authority decide not to conduct tax audit on a taxpayer after, let's say, 10 years. You cannot come back and audit the taxpayer. There's a limitation period. Now, what about tax investigation? Now, tax investigation is an advanced form of tax audit. It's just like a tax audit, but it's a tax audit that, you know, is where the tax authority in question has gone beyond the routine check to actually conduct an in-depth inquiry or investigation or scrutiny regarding the record of a taxpayer, you know, for previous years. It's always when there is a suspicion that the entity or the person involved has not been paying taxes, or has been underpaying taxes, or has been manipulating or fabricating accounts. And because of it, it is like an advanced state of it is more like an advanced state of tax audit. And because fraud is there's always an issue of fraud. Tax investigation may go beyond the statutory limitation period. So what are the distinguishing elements between tax audit and the tax investigation? First is the tax audit is routine. It's something they do routinely. They can do it every year or 2 years, 3 years, at least within the 6 years distance. But tax investigation is not, you can't start investigating a company yearly or conducting tax investigation, because of course you may have to, it is a very elaborate process. So while tax audit is routine, tax investigation is targeted because of maybe information that the revenue authority has obtained from other sources. They just they have discovered or had a feeling that a particular taxpayer, be it a company or an individual, has been underpaying tax. Maybe they have been seeing huge amount of money in the bank account, and you are not even paying any tax at all. They conduct an investigation. In fact, there's a special force within the FRS that headed by a commissioner of police in Abuja. They conduct tax investigation. So the objective of tax audit is just to verify your tax claim. You've been paying 500,000 naira yearly, or you have been, reporting losses. The tax authority would like to verify whether your claim is correct. Unlike tax audit, where a tax investigation that is based on suspicion that you have been evading tax. And like I said, the another distinguishing element is the limitation period. There's no limitation for tax investigation, especially because fraud is there's always an element of fraud on the part of the taxpayer. And when there's an element of fraud, the limitation period will not apply. Well, duration, medium, and long. The outcome of tax audit is assessment. They will assess you to pay the tax you have not paid or you have underpaid. The outcome of a tax investigation is usually, apart from assessment, of course, the tax authority will always collect money, but apart from the assessment, they will likely prosecute those who are involved in tax evasion. Then you have the triggering factors statutorily. Every state, both state inland revenue and the FRS are supposed to conduct the audit as a matter of routine, while like I mentioned before, it's always an issue, complaints, investigation, intelligence report that will trigger tax investigation. So this, I think, we end here, and tomorrow we'll continue with other tax issues. I would like to take some of your questions.
Okay, thank you, Steve. Thank you very much, Steve. So I'll just go on to the questions because we have just 12 minutes and then we can continue tomorrow. So the first question is from Kechi. Kechi says, Steve, what is judgment assessment based on? I guess you understand what that is.
Based of judgment assessment, yes. Based of judgment assessment, maybe just because I think that's actually what Kechi is asking. Now, based of judgment assessment is an assessment that the taxpayers the assessment by the tax authority on the best of judgment. They can look at base of judgment could be based on your turnover. Base of judgment assessment is actually where you have failed to assess yourself, where you have failed to pay tax or file your tax returns. So if you fail to pass, for example, whether or not you have earned income or whether or not you have made profit as a company, you have to file your income tax return at the end of the following year, because your tax returns are filed on a preceding year basis. So if you fail to file your tax returns, you could be assessed to pay tax on a best of judgment assessment. They will assess you based on what they perceive to be your the income you supposed to, the tax that you're supposed to pay. It could be based on your turnover. If you know you can have turnover without making profit, they can look at your turnover and say, no, you can't have turnover of let's say 100 million and everything is just expenses, disallowance and so on and so forth. Capital, you are claiming capital allowance and you get no taxable income at all. The authority will assess you on best of judgment assessment.
Okay, so the next question, Stephen is asking, Ikemefuna is asking, is a tax return the primary basis for a tax assessment by the taxing authority? If yes, is it possible to have a tax assessment on a given amount of money when the tax return has no record of the said amount?
Please, can you read that question again? It's not very clear.
He said, is a tax return the primary basis for a tax assessment by the taxing authority? If
when you
yes,
if yes, continue.
If yes, is it possible to have a tax assessment on a given amount of money when the tax return has no record of the said amount? Do you understand?
Well, when you file a tax return, what follows naturally is you assess yourself. It's what you call self-assessment. You file when you have a return, the return will also include what you have assessed yourself to be, what you think or from the record you are filing, what you're supposed to pay to government. So naturally, when you file a tax return, there will be an assessment unless your return is a nil return. If it's a nil return, that means you have no, even though you are filing return, because filing a return is compulsory, whether or not you have earned, whether or not you have a taxable income. But if you fail to file your tax return, like I've just mentioned earlier on, you could be assessed on a base of judgment basis. So whether or not there's a return, the tax authority can assess you. I can assess you on a base of judgment basis and ask you to pay tax. So you can still file a tax return, pay, assess yourself, and the tax authority could still think that you could be further, or that you by your standard or by the income, by all criteria that you're supposed to pay more tax, and they can reassess you to pay additional tax.
Okay, because we do not have a lot of time, most of the participants are asking for your advice on further reading for lawyers who are interested in tax. So please, could you just give us examples of textbooks, articles that we can read. I know that Dr. Jude actually said.
Okay. I promise everybody that is attending this lecture, I have a tax article I published at the Law Review International on tax planning. I'm going to share the article, the last year's article. Because we are currently in this year's article on tax planning law review. So I will share the last year's article to you. I also share an article I wrote last year on VAT. And as you can see, Dr. Jude, as a lecturer, has quite several articles. And he promised to share the articles. And I also know today, they have 1 or 2 articles to share. So on my own part, I'm going to share some of the articles I author or co-author. I'm going to share with all the participants who drop their email address.
Thank you very much, Steve. And we will be back again tomorrow. Just before we close, I'm going to hand over to Tobina Erojikwe, who is the chairperson of the Institute of Continuing Legal Education, to wrap up the session for us. Thank you.
Okay, good afternoon, everybody. Welcome, delegates. I want to thank the panelists today for today's session, Dr. Jude Odinkodigbo, Bidemi, and Steve Arubike. Thank you very much for what I think is a very brilliant presentation from all of you. I know a lot of people are concerned about whether or not they'll be getting the slides, but we promise that we'll get all the slides out to you, as well as the articles that have been promised. So today, tomorrow, you will get them. And for those who participated in the IP session, and also those who participated in the or who are participating in the oil and gas sessions, we'll just aim to get everything out to you today, tomorrow, and then get your certificates to you later on. So thank you very much for participating. Hopefully see you tomorrow. God bless you all. Thank you.
Thank you, sir.